Hey, good morning. Happy Friday. Happy Friday. I am so happy that everyone is with us today. I'm excited because Herb Levin from First Eagle Mortgage is with us. And if any of you know Herb, you know he does all kinds of mortgages. So you don't have to be, it doesn't have to be that standard mortgage. So welcome, Herb. Thanks.
Well, thank you. I'm happy to be here. Thank you very much.
So I know everybody wants to know what's going on with rates and whatever happens with inflation and the feds, how does it affect the rates?
Okay, well, there's a lot of misinformation out there concerning what the Federal Reserve can or can't do. Yes, they're trying to keep inflation at bay, and you know what's happening with inflation. Inflation is, you can look at it as the enemy of bonds. Bond prices determine mortgages. So if you have a bond and there's a lot of inflation, the bond is worth less when it's finally redeemed in generally 10 years. So that's the problem. So when that happens, bond prices go down, rates go up. It's an inverse relationship. However, the Federal Reserve does not directly affect mortgage rates. All they can do is affect those rates, such as home equity lines of credit, things you pay, car loans, credit card loans. Those are Federal Reserve affects those rates. So when they talk about the Fed rate, that's what it does. Mortgage rates, which depend on these called Fannie Mae bonds, have literally nothing to do with the Fed rate. In fact, oftentimes what happens is the Federal Reserve will raise rates to reduce inflation. That's good for mortgage rates. Okay. So if they increase the Fed funds rate, which they expect to do, it'll reduce inflation, rates will go down. Seems crazy, but it's absolutely has happened in the 20 something years I've been doing this. That's exactly what happens every single time. So a lot of misinformation out there.
That's interesting. So tell me just real quickly. I know I've had people say I'm at 4%. Should I look into refinancing? Is there a place where you're telling people to?
It all depends on a couple of things. Number one, is it a good return on your investment? Okay. There are some closing costs to refinance. So the question is, how soon can you recover those costs? Yes, we have no cost closings. Yes, we have those kinds of things with a slightly higher rate. So as an example, even if you could save 0.25% for nothing, that's a great return on investment. Okay, so you have to look at each person's situation is very different, and frankly, it takes a phone call, a few minutes on the phone, and we can tell you if it makes sense for you or not.
Right. That's what I advise anybody who asks me. I said, look, this changes every day. It depends on a lot of factors, but if you call her, you can get a quick answer. So,
Absolutely, it takes just a few minutes on the phone to see if it makes sense. In some
right.
cases, it does. In some cases, it does not.
Okay. Perfect. So now let's talk about what if you've had a bankruptcy? What
Okay,
if you've had a foreclosure?
okay. For the standard Fannie Mae, Freddie Mac type of loans. Bankruptcy, you have to wait 4 years. Foreclosure, 7 years.
Okay.
So it's a long time to wait. We have some alternative programs that one day after you complete your bankruptcy or foreclosure, we can get you a new loan. So very different. Yes, the rate is higher because it's riskier. So if you find that you've had a bankruptcy foreclosure in the last 6 months, a year, whenever, yes, you can buy a house if you wish, or even refinance.
And are these loans? They aren't an FHA loan.
No, no,
Okay.
no. FHA is 2 years. You have to wait 2 years FHA for a bankruptcy, 4 years foreclosure. So there is a time period you have to wait in general for what's considered a normal type of loan. VA loans are a little less, 1 year after that. FHA is 2 years. So it depends on the program. And the easy thing to do is if you had a problem, it takes a minute for you to call me and say, yes, this is what I've got. What can you do?
And can you help vets and And people, can you help people that want to pay?
Yes, as I said, we can do loans one day after you've completed the bankruptcy, one day after the foreclosure. The issue with the foreclosure is, as you know, sometimes the house stays in your uh, on title for a while. Okay, it takes a while for the bank to finally foreclose and take the person off the title. So we can
Yeah,
easily check that with county records.
right. And I think with the moratorium,
Okay,
uh, nothing was really happening in getting.
right. Yeah, people were well. They had forbearance. A lot of people
Yeah.
stopped paying when forbearance, which is fine. It gave them a breather, and then
Mhm.
now they're back. Forbearance, for the most part, has been over for most people, and then they can refinance once they've made payments for 3 months.
Okay.
They can't do it immediately, but after three payments, they can then refinance if that's what they want to do.
Okay. So let's talk about co-signing.
Okay.
What's, like what if your credit score isn't high enough? Let's go there.
Depending on the program, you can have what's called a non-occupying co-borrower, if you will,
Mm,
for somebody. If you have FHA, if you don't have quite enough income, you can have a parent, mother, father, brother, sister, niece, nephew, somebody co-sign with you, not live there, but help if with their income. Okay, we'd have to do the same thing with them. We'd have to get credit information and their income and everything else, and that's fine. You could also do the same for Fannie Mae and Freddie Mac. Normal loans, you could have what's called a non-occupying co-borrower if you need it. But remember, these non-occupying co-borrowers are on the mortgage, which means that if you don't pay, they have to pay it. So it's not like they're getting something for nothing. Okay, so the client's not getting something for nothing because whoever's on the loan is also on the hook for the mortgage.
right,
Okay, so it's just
right.
not lending the income; it's lending them for as long as they're on the mortgage.
It's taken a 30-year risk.
Right? It could be. It could be. Well, hopefully, these people who need somebody to help them after a couple of years have enough income to get them off.
Oh, okay. So
So
then
you
you could
can
come
get
back and
people
say,
off, but you have to refinance. It's not an
oh,
immediate thing to do that.
yeah,
But that's
right.
what typically happens in most clients that I've had over the years. In a few years, they make enough money, we just refinance and get the parent or whoever is on there off the loan because it does impact, you know, the parent's ability or the family's ability to buy their own house.
That's exactly right.
Okay.
Right. Okay. So let's talk about down payments for a second.
Okay.
Back in the day,
Yep.
uh, when I was growing up, everybody, and I still have people say, well, do I need to have 20% down?
Right. Okay.
So,
No, that's absolutely not true. It was true for years and years. But at this point, both Fannie Mae and Freddie Mac have 3% down payment programs. FHA is 3.5%, and VA is zero, no down payment. It's the greatest loan in the world if you've been in the service at any time. The programs, the rate is for Fannie and Freddie type general type loans, a 3% down, the rate is slightly higher. If you go 5% down, it's the same as if you put 20% down. So
okay.
5 to 15% down, the rate's the same. It depends on person's debt, how much money they have, how much income, how much money they want to put into the house. Okay. Just a side issue. My feeling is always a house is a piggy bank. You don't make any money, it doesn't appreciate any more than it's only worth what it's worth when you sell it. Okay. You're far better off taking the extra down payment that you could make and make an investment. You'll be in the long run, you're better off giving it to a financial advisor. We're not. So have you have plenty of them out there and have them make money for you. In the meantime, you can put less money as a down payment
Right.
but emotionally people want to get rid of the more they want to get rid of the mortgage. So it's different.
And I think that that's a really important point, that we have a lot of baby boomers now selling their homes and thinking that, well, I was supposed to make money on this. Well, you lived there for 40 years,
Right.
and there's a point of diminishing returns,
Right.
where it becomes old, it becomes obsolete, it becomes, so that in order to bring it up to today's standards, it would cost people a lot of money to get back there. So
Yes.
it doesn't exactly, you are better off to put your money.
Invest the money somewhere else.
Right.
History has absolutely shown that. I have
Yes.
lots of people who've done that and done very well over the years, because with the extra money they make, they could always pay off the mortgage if they wanted to.
Right. Right.
But there's hardly any need, especially now with rates so historically low. They're not quite as low as they were a month ago, but still, as of today, it's roughly 3% for a 30-year fixed.
Right.
Okay. I
Right.
remember it used to be much higher.
Oh, yes. I like to tell the story. My first house I bought it because I assumed an 11.5% mortgage.
Right.
And that was a deal.
Yep.
So,
Yep. That's true.
So let's talk about multi-unit buildings. You do that also. And
Yes.
what's going on? Should we be investing in that?
Well, it's a long-term plan. What you can do, and what a lot of my clients have done, is buy a multi-unit, live in one unit, rent out the others, and typically at the end of the month, they make enough money for the other units to pay the mortgage. Okay? They live in there for a couple of years. They then look around and buy another one and move into it and do that. It's a long-term plan. You have to be willing to be a landlord, number one, which is a different world. Number two, you have to have a plan for the future. And I've had a number of clients that have built up 2, 3, 4, 5 buildings, over the years. It's not instantaneous, but if you have a long-term plan and you're young enough, let's say you're 30. The average age, I guess, people buying a house is about 30, is what I've heard. So at that point, you've got many years to plan ahead, but it can be a terrific investment. And as you know, if you pick the right place, you can make the numbers work. Okay?
That's
Yes.
right. So think Monopoly
Right?
and think Park Place.
Yep.
So,
All
so,
true. All true.
yes, and there's tax advantages. There's a lot of
Yes.
they
Absolutely.
are a little rough to come by these days to find
Yeah,
a good
prices
one.
have jumped up. It's really, I don't know if that's gonna continue. If we're
Yes.
I don't know what's gonna happen with the market, that will continue, so they're not as good a value, I'll say, as they were,
Mhm.
depending on the area, for sure, okay?
Yeah, and that's the thing. None of us have a crystal ball. We don't know, um, which is a huge issue in real estate,
Right.
because the market in January, February, April, March, April, May was one thing. It
Mhm.
is very different today. And it is just in the Chicago metropolitan area, we are not as hot as we were.
Right, right, right.
So,
It may calm down a little, so
right. Yes, it's
maybe.
normalized. It's much
Yeah,
more normalized. It's
yeah,
not,
yeah,
right. It's just not, it's normalized, we call
right,
it.
right.
Right.
Exactly right. So we'll see, but it's an exciting market anyway for all of us, I think.
And now is the time with rates so low.
Yep.
And so anybody that wants to get in touch with Herb, I've got his phone number on Facebook here. You can contact me. Just a quick call to find out. It's not a bother. That's the other thing. If you
Not,
call,
not a bother. Takes a minute.
it takes a minute. They have tools to do this. Please call and find out, because you could be saving yourself $1,500 a year, or $2,000 or $3,000.
Yep.
So do reach out. And I want to thank you, Herb, so much
You're
for
welcome.
being
This
with
was
me.
fun. I've never done this. This is fun.
No,
Thank
good. We're gonna do it again. All right,
I
everybody.
I can't wait. And
Okay.
All right. Thank you.
Everybody have
Go ahead.
a
Sorry.
great weekend.
Okay. Absolutely.